Are you like most algo traders and only building strategies with profit in mind? That's what most people do. More sophisticated traders include risk measurements such as drawdown, and that's a good start. But did you know there's ways to build in risk protection that's even better into your strategies? I'm trader Kevin Davey, and today we're going to look at 4 different ways to build risk protection into your algos. So the last few weeks have been just crazy in the markets. A lot of volatility, up limits, down limits. And for a lot of people, their strategies have just gone completely crazy because they're not used to such volatility. So the question is, what can you do to overcome this? Well, one thing you can obviously do is just turn off all your strategies. I know quite a few traders who have done that during this time, in times of high volatility. They just turn everything off. And that's a pretty good option. But for some of us, we want to keep trading. So a good idea is to build risk protection into your strategies. And that's what I'm going to talk about today. 4 different things you can code in your strategies to help you with risk protection. And then I'm also going to talk about a technique, equity curve trading, and see if that helps or not. First, what I want to do is create a baseline strategy. This isn't necessarily a good strategy or a bad strategy, but it's a strategy that we can use and we can put some risk protection in it and see what it does. So it's a good sample. I wouldn't trade this strategy, that's for sure. So here are the results of the baseline strategy and how it looks. Okay, now that we know what our baseline strategy looks like, let's go with some different risk protection techniques, things you can put in the code before you run your algo. The first one's a daily loss limiter, and it is just what it sounds like it is. It tries to limit the amount of money you'd lose in any particular day. Well, here are the results with that added to the strategy. You can see, depending on the value that you use, you can actually improve this strategy. But it gives you at least a good idea that this is a possibility for something that could make a difference in risk protection. The second risk protection technique came up because I've frequently seen systems where they just take losing trade after losing trade after losing trade. And what would be nice is to cut out some of those losers, okay? Obviously you can cut them out after the fact, but what can you do beforehand? Well, one thing you can do is you can put a delay on any future signals. So for example, if your last trade was a loser, then just wait a certain number of bars before you can enter again. This prevents you from getting in over and over again, let's say trying to go short in a strong uptrend. So this kind of technique works pretty well in counter trend type systems where you're going against the major trend because it tries to limit the amount of chances you take against the trend. Here's how those results look. And you can see this one doesn't have a huge impact, although there are times where it is better. But it could also be a good psychological tool because you'd feel comfortable knowing you're not going to be getting into losing trade after losing trade. You take a breather in between. And sometimes that's more important than the actual dollar performance of a strategy. It makes you feel good. There's some benefit to that. The third technique for risk protection is not having open trades on weekends. A lot of people hate weekend trades and hate being in a position on the weekends. Just imagine in early March if you were long crude oil over the weekend when the Russians and the Saudis were fighting in some kind of price fixing type thing where the price dropped almost 30% for the Sunday open. That's a huge loss to take. So this strategy will get you out before the Friday close, and then you're flat going into the weekend. That's really nice psychologically, but how does it work when you put it to the test? Unfortunately, as you can see, it really doesn't help your performance. Maybe it gives you peace of mind and that's worth it, but depending on the strategy and the market, don't expect it to improve your performance. And that's true with a lot of these risk protection techniques. They're not necessarily going to make your dollar performance, your profit, better, but psychologically they could be pretty neat. And then our fourth risk protection technique I've talked about in other videos, and it's simply, if the volatility is too much, just turn off the system temporarily. It's pretty simple, it works pretty good, and as I mentioned, I talked about it in an earlier video, and a couple of people actually sent me results that they got with this technique added in. And as you can see, it cuts out a lot of losing trades, and it also just keeps you out during those high volatility times. So it's pretty neat. So as you can see, these four techniques may not improve your profit, but a lot of times they have a good psychological benefit. And that might be more important. You know, when the markets are crazy, you start getting stressed out about your trading. It's nice to know that your systems have built-in protection to keep you out of trades, to delay between trades, to maybe not be in trades over weekends. Sometimes that benefit is more important than just making money. Sometimes it's just about surviving in algo trading. The key with using any of these techniques, though, is one, put it in before you start testing. Don't build a strategy and then go and put that risk protection technique in and try them all and pick the best one, because that's just curve fitting. What you've got to do is put it in at the beginning, try not to optimize it, and just go with it. And if it works, great. And if you get a strategy with it, now you have that risk protection built in. And if you can't make a strategy with that risk protection, well, then maybe it's time to take it out and look at something else. But the key is you put it in at the start and then you test it with very little, if any, optimization and see how it performs. So those are four risk protection techniques that you can actually put in the code. But there are also things you can do outside of the code. For example, you've probably all heard about equity curve trading. It's a method of trading where you look at the equity curve after each trade and you plot, let's say, a moving average of the equity curve. And if the equity curve drops below its moving average, then you turn off the system temporarily. And when it turns back up, you turn it back on. It's a pretty neat idea, and a lot of people like the concept, myself included. And there's actually a guy out there who calls himself the father of equity curve trading because he claims to have invented it. So obviously, there's a lot to it. But does it actually work? Well, the answer, does it actually work, is yes and no. Yes, on certain systems, equity curve trading will help you. So for example, if your system falls apart, the equity curve trading will just turn your system off, and that's a good thing. Where it doesn't work as well is if the equity curve starts to whipsaw, because what will happen is you'll get out of the system, it'll turn off right before the system recovers, and so then you'll miss out on profits, and so you'll constantly be out of sync with the way the strategy is performing. And that's what happens a lot of times. And of course, if the system is doing real well, the equity curve trading keeps the system on all the time. So it works in that situation too. So I've spent a lot of time looking at equity curve trading and trying different things. And there's a couple things I've found that are important to share. One, most people calculate it incorrectly. If you set up a spreadsheet with it, it's actually pretty easy to mess up the spreadsheet and make calculations where you're accepting trades after the results are in. So in effect, you're looking ahead at your next trade. And obviously that's not right. That's what most people do when they build these spreadsheets. The other thing is, a lot of people will just try a whole bunch of different moving average values for the curve, and they'll find one that works, and then they'll say, hey, I got it. This is what I'm going to do. That doesn't work either. If you're going to use equity curve trading, use it from the beginning and don't optimize it. And then see if it helps or not. My experience is it does not help and it actually makes the performance worse. But maybe you'll see something different. So below, you can download code and resource material for what I've talked about today. You can also download a spreadsheet to help you do some equity curve trading if you're interested in that and the equations are correct. If you like this video, feel free, give it a thumbs up or subscribe to my channel. If you have comments for me, please leave them down below. I'll answer every comment and try to answer every question. And thanks for watching. I'm Kevin Davey. Have a great day.